Last week in review, Sunday, November the 20th. And we take the opportunity every Sunday to record a podcast that reflects on the major developments of the week past and some sense of outlook to the week ahead. We seem to be in the perfect nexus of that in all things COP27, as we've just seen the headlines move. Deal of some description. Let's go straight to Cairo, or not to Cairo, to Egypt, to Sharm el Sheikh, I believe. Bill Spindle, climate and energy editor at Semaphore. Bill, finally, as it always seems to be the case, a deal is done at the 11th and a half hour. What are your thoughts? Maybe give us a summary of what the deal is from COP27 and your thoughts on its significance.
Sure. It's sort of the 12th and a half hours since they've really gone over by a fully 48 hours beyond when it was supposed to end on Friday. Basically, Sean, this COP was really about two big things. One was finance. How are we going to finance a lot of things about the energy transition, but especially about this issue of how and should countries that are suffering damages from climate change, we saw Pakistan, for example, go through a terrifically awful summer. How should they be compensated? Should they be compensated? And who should compensate them? That was one huge issue in the finance arena. The other issue, really, that kind of crept up on the COP, I think, was secondarily, it was about sort of what is the role of fossil fuels going to be in this energy transition? Is it going to be one, or is their role to go away completely? Is their role to continue doing their job as they're doing it now? What's going to be the role? Those two kind of came together at the end, almost in a way that really points towards, I think, the next COP out there where you guys are in Abu Dhabi or in the UAE, which is where the big meeting is going to be held next year. And what kind of came together at the end, sort of, was that they agreed to establish this loss and damage fund that refers to this specific kind of finance for countries that are being hurt by climate change.
So did they put a dollar number on that?
They left all the details to be settled later. Who's going to pay into it? How much is going to be paid? Who will receive the money? What form it will come in? Everything was left really to the end. But nonetheless, that was a huge step and probably a necessary step to hold this whole process together, because there were really so many countries that were just demanding something be done, or they were going to basically walk out of the process. So at the end, there was an agreement to establish this fund. That's a huge step in a way for many of these developed countries who were refusing to even consider the prospect. At the end, that we can talk as much as you want about it, it got linked quite interestingly to this idea of fossil fuels and whether they should be phased out completely. That never got across the finish line. The EU tried very hard and really got together a coalition of almost 100 countries that basically said, we'll establish this loss and damage fund and presumably be really proactive about it in exchange for language that basically said we'll phase out all fossil fuels. Now, that kind of language was adamantly opposed by countries like Russia and Saudi Arabia, and even really by the US, which kind of came in with a final offer to sort of phase out what they called unabated fossil fuels, which sort of means fossil fuels, you would continue using them, but you would remove the carbon dioxide and carbon emissions from those processes. All of that, that's sort of where it ended. Very satisfying for the group of countries, small countries, vulnerable countries that were pushing for this loss and damage fund. They've got that. They feel like they can expand that, but it's true. All the details were left to be argued about a year from now, and this fund won't even go into operation until probably at least a year beyond that. So satisfying for those countries, big step for those hoping for loss and damage and for worrying about what those countries are going to do. Unsatisfying for countries like the EU that were really pushing to go beyond the Glasgow statements that came out at last year's COP. But I think the oil states and the oil producing countries, including the US, were less unhappy with it. And some of them, I think, were quite pleased.
Let's go to Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Mark, your thoughts on that? There was a sort of position taken by the EU late in the week last Friday before, I mean, the conference was meant to end, which they were basically threatening to walk out if they didn't get some kind of agreement beyond Glasgow, which meant moving from not just targeting coal, but targeting all fossil fuels. It looks like EU got nothing out of this. Your thoughts on the agreement?
Well, I think there's sort of three observations. One, I think there's a report, if I remember rightly, from Goldman Sachs out saying that in the last 10 years, we've invested something in the region of $3 trillion globally in trying to reduce carbon emissions. And thus far, the impact has been, well, up until 2021, a drop from a drop in power supply generated by hydrocarbons by 1%, and it would have likely risen this year. So we're back at the 82% where we were. That sort of is a stark reminder of the sort of numbers that we really need to talk about when we're going to be investing in this. Two, the EU coming away from this with nothing to a certain extent doesn't surprise me. But then again, the EU really needs to look at its own backyard. Look how it's failing at the moment to agree on coordinated gas buying, because there's such divergent interests within the EU itself on this particular topic. It's important that we've got this step. I think the signal thing is that the developed world has to help developing countries, but it needs to go well beyond just the damage from emissions. It needs to go into the world of how are we going to help them transition? And that's a much taller order issue, particularly with so many of the oil producing countries also resistant to this idea of completely phasing out hydrocarbons, which I think is unrealistic in any case, particularly from the petrochemical side.
Well, it certainly, as Bill points out, puts hands the bucket over to the UAE, hosting COP28 that has as many questions, it would appear that it does have answers. But I think the kind of Rubik's Cube that the UAE will sort of thrive in trying to solve, enough of a bridge to a roadmap forward, but not necessarily with total clarity that maybe the muscle of the EU or the UAE will be able to do. Just one last comment from you on that, Bill, your thoughts on that handover to the UAE and given the Rubik's Cube analogy.
Well, I think that's going to be really interesting because the UAE, really has strong credibility in the area of renewables, in investing, not just in the UAE, but around the world. On the other hand, it's also trying to expand oil production by, I believe, 2 million barrels a day, right? So that's putting it in an interesting spot for that, to begin to navigate that discussion. I also do think, though, that Mark is right, that Europe has a very interesting, it's going to be an interesting year for Europe to really show that it can walk the walk and go into the next COP showing that it has, in fact, managed to get through this real crisis period and keep its energy transition, i.e., in their minds, phasing out fossil fuels, including gas, on track. Now, if they do that and they show up and show that they've gotten over the hump, right, and showed that we needed more gas to replace the Russian gas immediately, but we're really now on a glide path toward phasing out all fossil fuels. If they could start to show that that's beginning to happen, I think they'd come in with a lot of clout. Now, if they come in, where they are today, which understandably is pretty muddled given the difficulty of the situation, then they'll have a much harder time making their point.
Let's move on with the other big story last week, which is obviously the more immediate flat price on oil. We saw Brent crude close the week quite lower than where it started at $87.62, notably under that very important threshold of $90 a barrel. We've seen in the month and a half since OPEC met in early October, oil prices were at $98. They came off, then they went back to $98, and now they've come off even further, significantly below 90, and we're now 2 weeks out from the next OPEC meeting. So we have to look at where does that take us, and the outlook and signals might be for even deeper cuts. Mark, your thoughts on that trajectory, the oil price, the Brent declining below 90, and what it signals going forward?
Well, I think it's one of those things where you have to divide up a couple of influences, one of which is very technical, and that is we are going into year end. It's Thanksgiving this week, and the liquidity in financial markets, as we saw with that ridiculous rally that we had on Thursday in the S&P 500, that is basically telling everybody that underlying liquidity conditions in financial markets are extraordinarily poor. And people may say, well, hold on a minute, it went up. Isn't that a sign that everyone's going in? No, it's not. It's a sign actually that there is no liquidity in the market. So I think to a certain extent, this move down that we've got in oil prices is because financial markets are always obsessed with the demand side rather than supply side. I think most people are thinking, well, maybe the supply side's slightly better, having looked at some of the inventory numbers that we've had. I'm not really convinced, given where we are in absolute terms in inventories. And I think it's one of those situations where, as long as we keep on focusing on the negative growth outlook, and we've now got people really fretting about the US despite the better than expected retail sales, but above all worried about China, certainly worried about the euro area and the UK. And so we're focusing in on that. And I suppose the real question is, well, the real irony here is the US castigated OPEC for that 2 million nominal production cut a few weeks ago, and now it's looking like their position was vindicated. And I think this week will be really key in terms of hearing from OPEC as to whether they really want to basically get behind even more cuts at the next meeting.
Bill, it does look like one of the strings in this narrative on the oil price, obviously has been for a while, is the direction of travel for the Fed and the tightening cycle, which has been, we've had 4 75 basis point meetings. We're a few weeks away from the last one of the year. And there's an increasing sort of forecast that the Fed's going to blink and come away from its sort of big hitting. Your thoughts on where the appetite and the US economy is at, and the Fed's position in moving forward with more robust rate hikes?
Yeah, I think as we've talked about before in this, the US kind of remains in this kind of funny place where it seems to be going quite well in many respects, particularly job growth. So you get the Fed continuing to ramp up interest rate hikes at pretty large scale. But you did start to see a couple of Fed governors in the last week or so kind of show a little hesitancy. I think Lael Brainerd said something earlier in the week, and there was another Fed governor that said something in the last day or two, that they are thinking that perhaps the rate of increase maybe needs to pull back slightly. So they probably see some signs that the economy is really beginning to slow in some ways, probably even the job market, if not the headline numbers. So, I think there is a sense that, and so then I think to some extent the markets are responding to that by saying, well, I guess this recession is finally coming. And they're responding less to the interest rate hikes than the underlying sense that the economy might be slowing a bit.
There was, Mark, a week ago when we were having our week in review, a sense of optimism, wind in the sails that China, which had just announced last weekend, the kind of salvation of the real estate sector with all sorts of freebies and giveaways. But as the week went on, it seemed China drifted back to that, no, we're still closed for business posture.
Yes, I mean, in terms of China, I suppose there's two things. One, with the property sector, we always need to remember that there's two sides to this coin. the property sector's debt, which does need to be resolved and which they seem to be trying to make all these efforts to try and resolve, doesn't take away from the fact that to actually get the property sector going again, you need demand. And this is really where the problem lies, because 70% of China's savings are already locked up in the property sector. And I think a lot of people at the moment in China, without something much more forceful, are probably not exactly going to be rushing in, particularly as there's been a number of false starts on that front from other measures. So, but the underlying profile of China's economy still remains rather weak. And underlying it all, we look at the narrative from the Xi and the Politburo. It doesn't sound like there's any real willingness to do the sort of stimulus that would be significant in terms of the global economy.
Is there a stimulus pathway that would have an impact? I mean, there's a sense that there's no more cement you can throw at a wall that's going to give you growth. I mean, that whole sort of previous model of build and construct will give you, economic activity and hence stimulus and so forth. That option seems to be gone now. What would be a stimulus option that would have impact, do you think?
It's actually quite difficult to think of at the moment. I think really what you'd need to see is a reduction in tensions with the West, which is just not going to happen. That's unrealistic. But perhaps something which offers much more in the way of incentives, as I say, to the buy side of the equation on the property side, might, something which is particularly targeted, because they've obviously understood that the spaghetti principle of throwing as much against the wall and hoping something sticks really isn't, an option anymore, particularly with the volume of debt that they've got at a corporate and a consumer level, and to a certain extent, above all, a local government level. So
that's only the debt that we can see, the whole dark box that we can't see. But meanwhile, Bill, India is sort of defying all sorts of gravity logic. We've just had the numbers out reporting India's economy is expected to grow by over 6% in the second quarter of their fiscal year. What's happening there? How can India be defying this sort of global picture?
Yeah, I think they've just got their economy. They've come out of COVID pretty much. I think they're getting things. India's always a bit of a muddle, but I think they've got kind of most of the pistons kind of operating in the right direction at this point, and they're starting to see some real growth driven by domestic demand significantly. They've probably gotten over the worst of the shocks from the different oil crisis, food crisis, all these sorts of things. So they've just continued to sort of power through that for now. They still have a huge amount of underlying structural issues that need to be addressed over the longer term, but they seem to, be able to hold this recovery coming out of COVID. And I think it's still, a lot of it still is recovery from the COVID dip.
The old revenge buy. Mark, same on India, sticking there. Clearly, India seems to be one of the big countries that are most vulnerable to the oil price cap and to the embargo that is about to be introduced in Europe on Russian oil, because India doesn't have its own fleet, B, they don't have their own insurance architecture in which to sort of step outside of the long arm of the EU. What is your thoughts on India's vulnerability an opportunity to keep enjoying cheap Russian oil?
Well, I mean, the fact is that oil prices at the moment are coming down quite sharply, and so that benefits them. Yes, the finance issue is definitely finance and insurance issue is something, but to be honest, I think the way things are going at the moment, the whole non-aligned area that includes the GCC, most importantly, which is obviously closely allied with India. There is an opportunity to actually build up their own capabilities on that front, particularly with the capital flows which are going out of the US, out of the EU and the UK towards the UAE. And, this is an opportunity actually for both sides to start saying, well, if they don't want to provide the finance, why don't we? And I think that's And there's always a way around all these sanctions. I think we've seen it with Iran above all. We've seen it also with Venezuela. Yes, Russia is a bigger fish in that particular pond, but I think ultimately for India at the moment, the bigger challenge is actually overall export demand is starting to tail off, and you're starting to see it in the local export numbers. And that's probably the bigger challenge, though there is a big advantage coming through from lower energy prices as a whole, though there remains a question over food prices.
Let's go to the survey question and look sort of the week ahead as we come away from the distraction of COP, which of course has sort of kept a lot of governments and the Asian meetings with the big outlook there. But do you expect OPEC Plus to make deeper cuts at the December meeting if Brent crude remains below $90 a barrel? They seem to have certainly been quite determined to balance the market, as they like to phrase it, but ultimately to defend $90. Will they do so again? Can they do so? What is the expectation in the room? Bill, we did mention earlier, I welcome your thoughts on that question, OPEC Plus continuing to try and defend $90 a barrel. Is that viable from a demand supply point of view? And where would the US administration take that step? You're on mute, Bill, sorry.
Yep, there we go. I think they perhaps will try to again, announce cuts. Their ability to enforce cuts and really bring supply off the market was pretty limited before, is even more limited now. So in a sense, do you mean real cuts or do you mean symbolic efforts? And I think they could mount some symbolic efforts again. May well do that, but how much they can really take off the market at this point is real questionable.
Do you think, just to take that a step further, the last time they announced their cuts, obviously in early October, the US government, it was seen as a real slight to the relationship. Has that now passed, or is there still lingering legacy that would make another cut even more problematic?
My guess is both sides would work to avoid a sort of head-on, public collision like they did last time. I don't think, that kind of got, I think it is kind of passed, especially since the Biden administration made this decision last week to treat MBS with immunity in courts. That's a complicated issue, but basically the Saudis had long wanted that, and that was a big sign that the U.S. does not want to see a giant rupture in this relationship, and I highly doubt the Saudis do either.
Mark, your thoughts on that? Looking, obviously, the OPEC Plus meeting does take place the day before the EU embargo on Russian oil. Where does that, you mentioned earlier that everybody's focused on demand destruction rather than supply concerns, but could that shift? What's your thoughts on where those two things come together in early December?
Well, I can't see the fact that demand concerns is going to go away as a factor anytime soon. So that's really going to remain fairly dominant. But we keep on getting this wave of, but supply. And it's interesting how we go through it. So I suspect that, I agree completely with Bill. All of this in terms of actual cuts is a completely different issue. But nominally, as long as the market is as weak as it is at the moment, regardless of whether it's partly to do with seasonal factors, I would expect them to implement something nominal, probably not nearly of the same sort of size, maybe a 500,000 barrels. And people will go, well, that doesn't really mean much in the greater scheme of things.
Well, it does if Saudi cut them.
Yes, it does, exactly. And that will be the issue of, who's going to cut. So it's less a question of what OPEC Plus does and far more a question of, well, who's going to actually hit the nail on the head? Who's going to dot I's and cross T's on this?
As we go, Bill, into the sort of holiday season with as we just mentioned, the American Thanksgiving, as well as then we're sort of knocking into Christmas, where the momentum of economic sort of these trends that sort of have guided the most of the year, the tightening cycle of the Fed and other central bankers, the inflation, has it peaked or not, the war in Ukraine. Just welcome your thoughts of where these sort of threads, where do you see these threads come together now as we come into this sort of natural slowdown period at the end of the year?
Yeah, that's a lot of threads to try to figure out.
Yeah.
I would say,
I mean, it seems like they're all sort of calming down a bit, the stress of them.
Yeah, I think the question really is the big $1 zillion question that we've had all along is, can the Fed somehow, some way, miraculously stick a soft landing? And I think that will be the speculation. I think that's still very, very hard thing to do, given how fast they've raised rates and the sort of messiness that's out there in the economy itself. So, but I think that's what these Fed statements in the last week or so have kind of raised that question of, are they starting to think, okay, now's the time to sort of begin to try to stick that soft landing? But boy, is that a small landing strip they're aiming for.
Mark, your thoughts on that? I mean, it does, the soft landing piece could be a shallow recession ultimately, rather than a deep one. But where do you see these sort of major threads from 2022 sort of finding their way towards the end of the year? Is the steam coming out of them all, or are we building up for another bang?
Well, I think, the Fed discussion is certainly going to go on. I think, it's such a small landing pad that even a fly would actually try to, struggle to actually land on it. And so the point really boils down to at what point do financial market conditions become so adverse that they take the foot off the pedal? Because as far as I can see, the situation is, yes, inflation is gradually going to come down, particularly with energy prices coming down the way that they have, if they stay down, which is obviously debatable. But the unemployment rate in most countries is not going to go up. In fact, if we actually look at the cumulative losses in the tech sector, which we've also been obsessing about, and is our great sort of almost like a leading indicator for a lot of people about growth, I still think we're in a situation where employment isn't actually going to suffer enormously, because we've got so many structural issues. So we're still actually trying to understand what the post-pandemic world looks like. And that, in fact, is probably the biggest challenge for all these central banks, because they seem to be trying to control something which they can't control using indicators, which are probably the wrong ones for the moment.
And just you mentioned in your earlier comment, I just wanted to circle back to it before we close, that the financial markets have continued to sort of take any indicator to go back up, to sort of reverse back to that sort of 10-year bull run, if you like, that even despite all the Fed's action so far, they can't seem to take the steam out of the financial markets.
Yes, I mean, but I would say we're only in month 3 of maximum Fed withdrawal. Bank of England's now starting to sell. With the withdrawal of liquidity, which was so enormously injected during COVID, has been actually quite a slow process, and it's really going to start to hit home much more in Q1 than it has at the end of the year, despite all the other factors that operate at the end of the year, due to end of year people closing down their books.
Well, as we close out our comments, let's get the survey result, which we'll post on Twitter today. As long as Twitter is still available, we will use it. It looks like Elon Musk is doing his damnedest to give it a good whack. But my last question to you both is a very simple one. Who's going to win the World Cup, which starts in about 6 or 7 hours from now? Finally, after 12 years, Qatar will get to blow the whistle and kick this thing off against Ecuador. Bill, America, the US are in the World Cup. Your thoughts?
I'm going to sentimentally push for America on this one.
Why not? Absolutely. Apparently, they've got a pretty decent team. Mark?
The very strong consensus at Global Grain last week amongst all the Latin Americans, Brazil.
Brazil. Well, I'm going with Wales just for a bit of nostalgia and sentimental. They'll at least get out of their group. It'll be a great group, actually. Wales, England, Iran, the United States. So certainly a lot of fun to be looking forward to the World Cup. After all of the other stresses that we're dealing with, it'll be nice to be slightly distracted without a Budweiser in your hand, nonetheless. Bill Spindle, thank you so much as always. Great work, great coverage from COP, and we'll continue that conversation going forward. Mark Oswald, as always, thank you so much for your insights this Sunday morning with Brent crude starting the week well below 90. Which direction will it move over the coming days? Should be quite informative as to where OPEC Plus will try and take some action again. Take care. Thank you.